Corporate finance practice problem using OneNote. Cost of preferred stock percent. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're going to be in the icon on the left-hand side in the practice problems down in the 1123 cost of preferred stock percent tab. Also note when using OneNote, take a look at the immersive reader. Many of our presentations up top will be mirrored in the text area down below. Same name, same number, having transcripts that can be translated into multiple different languages and either listened to or read in them, thereby being a good complement to the presentations up top. Closing out the icon on the left, information here we're going to be calculating in the blue area on down below. Remember that we are talking about the financing of the organization. Two main categories to keep in mind. We've been looking in prior presentations at the debt category. When thinking about the debt category, you got to take into consideration the tax impact versus the equity category. When taking into the equity category, we do not have that same kind of tax impact, but we do have that added complication of the equity kind of side of things. When we're on equity, common stock is usually the thing that we would think about, meaning the ownership of the organization, giving an equity interest in the organization with voting rights and whatnot with it. However, we also have the preferred stock, which is a bit more limited and thereby being a little bit easier for us to calculate typically due to that. So that's what we'll go to first here on the equity side, and then we'll move on to the common stock in future presentations. So we can sell the preferred stock, we're saying at the 150, and the estimated flotation costs, which we're going to say are the costs of us in order to issue the preferred stock. When you think of flotation costs, you can think about like the cost to float the stock out there to see if you can sell it, float it out on the market. You know, those are going to be the costs for us to get the stocks out there, one-time costs, as opposed to the dividends. Dividends are going to be the things that are going to be the annual costs that we're going to basically have to pay. The preferred stock, you'll recall, is a little bit more standardized in terms of the dividends that we are believing that we're going to be issuing. When we move to the common stocks, the dividends can be a little bit more confusing, and we typically have to take into consideration the value of the stock a little bit more closely, given the fact that we're giving kind of an equity interest voting rights in it in that type of situation. Also note, when you're considering this, we're going to be trying to compare this percent to something like debt financing. Debt financing has a maturity date, so you got to keep kind of that in mind as you do these calculations. You know, when you think about a bond, it might be like a 30-year bond or something like that, but it still ends in 30 years. When you're thinking about the shares, then it doesn't really have that same kind of termination date. It's just, we're going to assume dividends of $9 annually as basically the cost that we're going to try to compare on a percentage basis. So we'll do the same kind of percentage kind of calculation here, so we can compare, as they say, apples to apples to other financing methods, possibly including debt financing methods. So we have the annual dividends per share, we're going to say is the $9. That's what's going to cost us. It's going to cost us that on an annual basis in order to get $150, because that's what we're going to sell it for per share. But we're not actually going to get $150 because there's a one-time cost. So that's why I'm going to have a subcategory of the net sales price, I'm going to call it, which is the sales price of that $150 minus the flotation cost. These two costs are not the same, in that the $9 cost is what we think we're going to have to pay on an annual basis, whereas the flotation costs are the costs for us to get the money out there right now. So in order to get the $150, we're not actually going to get $150 after we basically make the sale, because although that's the price, we have to pay out the $4 at that same point in time, basically, and we're actually going to get then the $146. So in order to get the $146, we're going to have to then pay on an annual basis, we're saying a dividend of the 9%. Once we have that, of the $9, not 9%. Once we have that, we could take the $9 divided by the 146, and that will then give us our rate here. And that's going to be, if we move the decimal over, the 6.16 about. So once we take into consideration any flotation, which can complicate things a little bit, it's a pretty straightforward calculation for us to get a cost of preferred stock percent that we can then kind of compare out. And note what we do not have here in this calculation. We do not have the added complication of the tax impact, because this is an equity situation. When we pay out the dividends, in other words, it's not impacting the income statement because we're taking it out of equity on the balance sheet. And so it doesn't have that tax effect, as does the debt financing, which typically the payment that we have to pay out is in the form of interest, which is an expense on the income statement, thereby having an impact typically on taxable income, net income, taxable income, and therefore having a tax implication as well. Then when we move on to the common stocks, then we have to add, an added level of complexity, in that we think of the common stocks as basically having claim to the net value of the company. So we then have to think about the growth kind of component, and we also might have to think more in depth about the change in the dividends that could be taking place. So we have to consider those options as well when we move on to the other side of equity, which would be the common stock. Probably the more common thought when we're thinking about the issuing of equity side of things, people having an equity interest, an ownership interest. And in that format, you're thinking about the accounting equation formatted as assets minus liabilities equals the equity or the net asset type of calculation. And the value of that is something that would be given as well in terms of issuing the common stock.